Well, good afternoon, everyone. My name is George Hay. I'm an associate editor at Reuters Breakingviews. The title of this session, as was just said, is Pump Priming Asia. And we've got a great panel to unpick that issue for us. So we have Jason Dorr, the Head of Emerging Market Strategy and Head of Research Asia Pacific at SocGen. We have Michael Howell, the Managing Director of CrossBorder Capital. We have Dr. Bill Maldonado, the Global Chief Investment Officer Equities at HSBC Global Asset Management. And we have PK Basu, the Chief Economist of realeconomics.com. Welcome everyone. So here we are 2 to 3 months into this pandemic crisis, or the worst of it, and many countries are now starting to think about or actually easing their lockdowns. So the real issues are kind of what sort of recovery are we looking at? And does it carry with it a major risk of inflation? And obviously we want to look at it through an Asian perspective as well. So I'm going to start with Jason. Early on, the hope was that we would have a V-shaped recovery. What letter of the alphabet does it look to you now?
Yeah, that's a good question. Obviously, there's lots of debate. A V, a W, an L, a U, an I, other permutations of that. I think when we look at, economic cycles in the past, historically, they have been V-shaped. Where that happens now is going to largely depend on, the stages that different countries are in as far as easing lockdowns, how quickly that happens. We could see in a country like Singapore, it's happening quite slowly, for instance. So that's going to be a big factor. And I think, also different than past cycles, it is going to depend on if there is a semi-permanent or permanent change to corporate and consumer behavior and the trade-off between spending and savings. So people and corporates do choose to do less capex, less spending, choose to save more, given the severity of the shock, then the recovery could be more muted than what we've seen in the past. And I guess I would refer to, the IMF forecast. They're usually an optimistic bunch, and my takeaway from their most recent update was fairly pessimistic in the sense that, it takes a long time to recover the lost output. To the end of 2021, there's potentially $1 trillion lost output versus what was the trend or baseline prior to COVID. So it is going to have a substantial impact, and it's probably going to be fairly slow, even though the initial response could be quite quick. To recover that lost output could take a long time.
Yeah, I mean, the whole assumption, well, this is an exogenous shock. That's why people were thinking in terms of a V-shaped recovery. But it obviously depends on whether we get a second wave of infections, I suppose, and that's kind of, we're in this no man's land where we may or may not be about to get that. Do you or anyone else have any thoughts on like whether we're kind of underplaying the risk of a second wave at the moment?
If I want to chip in, I think we're hugely overplaying the risk.
Overplaying, right?
It's that what we're seeing is a fairly normal response to a virus. It's following a pretty normal course. I think if you look at some of the wild estimates that have come through about how bad this could be, they're paling against the reality. If you go back to the SARS epidemic, 10 years ago, there were a lot of expectations that SARS would come repeatedly year after year. We've never seen it again. I think one's got to take an optimistic view. And if you look at the history of viruses, they may well come back, but they normally come back in a much more moderate form. And I think
interesting. Just while you're on, Michael, what was really obvious at the start was the quite aggressive response from the central banks, and particularly the Fed. Do you think they've done all they need to do, all they are going to do, or is there more that they will do or could do?
Well, if you look at the numbers, there's a lot more they're going to do, and there's a lot more they can do. Most of the response to date has been led by the Federal Reserve. The Federal Reserve's balance sheet is, getting up to $5 to $6 trillion from 4 trillion or just over 4 trillion about 2 months ago. We think it's slated to hit over 10 trillion this year. So there's a lot. That's for sure. And then you've got other central banks that are basically following the Fed's lead. But the reality is that 85% of the injections of liquidity so far have come from the Federal Reserve, and that even excludes the swap line. They basically began to inject with alacrity very soon as the crisis began. So I think that the fact is that central banks have got a lot more room to move. One central bank that has not moved in any way, shape or form yet is the People's Bank of China. We're waiting. Right. Quite likely they will, but there are no signs as we speak.
Right. Bill, I mean, we were talking about central banks having a kind of good crisis thus far. You've seen there was this huge outflow of money from emerging markets, and then the Fed intervened, and that's kind of come back to a certain extent. Where do you see that going? And I suppose, from an Asian perspective, is this has what the Fed has done? Do you see that as sufficient where we are now?
Well, first of all, it's very good to have Michael on the panel, because I'm, for a change, not the most bullish person perhaps on the panel, or at least equally bullish. But I do think it's tough sledding for EMs. They've already got FX and local currency spreads going against them since the beginning of the crisis. That doesn't help. They're sort of racking up their twin deficits. They've probably got less room for fiscal maneuver, therefore, than developed markets. The EMs are also in lockdown, but they have weaker health systems, and it's sometimes harder to keep people in lockdown anyway. So perhaps their disease control isn't as good as some developed markets. A lot of the EMs are petrostates as well. Not all of them, of course, but many of them are. Brazil, other important EMs, Russia, if you call it an EM. And I think to make it even worse, they're exposed to the growth in the West. So whilst the West remains in the doldrums, while the US and Europe are not recovered, that's impacting them as well, even if they do manage to get local conditions more under control. So I think it's very tough, and I think we're very far from out of the woods in those emerging markets. There's a long way to go, and for them to do well, I think developed markets have to recover. But I do share Michael's underlying optimism. I think this virus will be overcome, so you can look forward 6 months or a year or whatever it is, and you see these massive stimulus packages, fiscal and monetary, in place, and at some point they'll really kick in and get to work. The problem is the path between here and there is extremely unclear. There's an unusually high level of uncertainty, and I would say especially for emerging markets. But out of all that, I think Asia looks very good, particularly non-emerging Asia, so North Asia, Taiwan, Korea, China, Hong Kong. I think that's where it looks interesting.
Right. Now, PK, bring you in. Do you agree with those kind of relatively optimistic sentiments? And I mean, who do you think of the Asian economies of having a good crisis, if it were?
Okay. So I think the Asian economies that have really weathered this crisis remarkably well are Taiwan and Vietnam. They're the standout cases where COVID has had almost no impact at all. And consequently, we've seen their economies survive relatively unscathed. And actually, if you look at a few other cases, Singapore, one would have thought would be facing a disastrous period, given its dependence on tourism as a big driver of its services sector. But we've seen spectacular growth in Singapore's manufacturing output, primarily because about a third of it is pharmaceuticals, and pharmaceuticals demand is going gangbusters around the world. So in fact, in the last 2 months that we have data, Singapore has has not seen any contraction in manufacturing exports. In fact, it's seen spectacular growth, 17% in March, 10% year on year in April. And similarly, if you look at Taiwan's numbers, they've been pretty resilient through this, and so has Vietnam, of course. So I'd say that there are a number of cases in Asia of economies that have weathered this crisis remarkably well. And I don't think we can look at emerging markets as a single category. We miss too much of the nuance. If we focus on all emerging markets as a single basket, I think, as Bill more or less pointed to as well, there are vast differences. If you're an oil exporter, of course, you're in much more trouble than others. Russia, Brazil, Angola, etc. So those are the troubled cases. But if you're an oil importer like India or Thailand, then in fact this period of remarkably low oil prices is potentially a boon. But of course, in India, for instance, the COVID curve has not entirely flattened. Even if you look at the logarithmic scale, there really hasn't been a flattening yet. And so there are some risks there. But I think what India has done with this crisis is that it has taken the opportunity to undertake some long-needed reforms. It has dramatically reformed the agriculture sector, which was the one sector of the Indian economy that hadn't been reformed since 1965. So we've seen some spectacular reform in the agriculture sector. We've seen quite a bit of significant reform in the manufacturing sector and labor market reform. So now India hasn't got COVID under control, but it's got its long-term structural issues sorted out. So I think there are a lot of interesting opportunities in Asia. And if you look outside Asia, it's worth noting that Africa, more or less, is unscathed as well. Africa is not considered an emerging market universe, mainly frontier markets, but that's another place that you can find interesting opportunities.
Just wanted to butt in there, just pick up on something you've kind of all, in a way, tangentially talked about, the transition from where we are to where we're going to be post recovery, and maybe bring Jason back in here. Just on the inflation point of view, a lot of people are kind of flagging it as a key risk as we kind of emerge and progress in the recovery. How do you look at that?
Yeah, I guess, if anything, it's probably, quite far down the road. In the next 1 to 2 years, we're going to be working through, a very large negative growth shock, a deflationary shock that's hitting the world. And, people's concern is, given the amount of stimulus that's being put into the economies, is that going to create inflation in the future? And I think, history has taught us that central bank liquidity injections or central bank balance sheet expansion, has not really generated inflation to the degree that people were expecting at the time. We can take an example from Japan all the way back in the early 2000s. The Fed during GFC, the ECB during the European financial crisis. Now, would inflation be lower in these countries if it weren't for that? Yes. But that concern about stagflation or runaway inflation, I think, is probably a little bit misplaced. And the reason for that is that credit demand was never strong coming out of these crises. And if that's not the case now, then all that balance sheet expansion just really sits around, stays on bank balance sheets, for instance. It doesn't get transmitted to the real economy. So it really depends on how the transmission mechanism is working and what the demand for credit is. I think we could probably argue that the demand for credit in the US is probably higher than other places possibly. But we didn't really see strong credit cycles going into COVID. North Asia was stronger than the rest of the region, but they weren't really that robust to begin with. So it's kind of hard to think that, if consumer and business behavior does change going forward, at least at the margin, that there's going to be that big inflationary impulse coming.
All right. What Bill or Michael or PK, what do you think of the inflation risk? Are you sanguine, maybe, Bill?
Well,
yeah, Certainly for the moment. I mean, if you think about the traditional drivers of inflation, one driver that's absent is kind of a zero or even negative output gap. So there's clearly a lot of slack in the economy. Demand has yet to recover, even in countries like China where supply has recovered. Another driver is inflation expectations. I don't know anybody, any kind of consumer that's making advanced purchases because they're worried about inflation. So that's really not happening. I think the one joker in the pack might be FX. We might see some very big FX moves, as I referred to earlier, particularly in emerging markets, as a kind of a shock absorber mechanism, and that might fuel some temporary localized inflation. So I suspect we need to watch out for that. But in terms of broad-based price increases in developed economies, that just doesn't look on the cards for the moment.
Right. Any other thoughts on that issue?
Well, I'll just make one point, and then we can go on to a longer discussion about it. But I guess, on the FX side, yes, it's a risk, but I think what we've seen over the past, 10 to 20 years is that, transmission mechanism from currencies into inflation fall quite dramatically in EM. So it could be there at the margin, but it's probably not a huge concern. And I guess, the other wild card to this, argument that we're making that inflation is probably not a big problem is, what happens to global supply chains and global trade, right? We had a lot of globalization that happened over the past 20 years that arguably kept inflation fairly suppressed. And if you're going to have reshoring activity or changes in the supply chain, that can have an impact. And that was already starting because of the trade wars. Global trade volumes weren't all that great in 2019, and potentially this accelerates that dynamic. So that's a risk. I guess my opinion is it's a little bit in the future, but yeah.
Right. PK, do you want to add something?
So, yeah. Okay. So quick couple of points. I largely agree with what Bill said. Inflation expectation, all of that, lack of an output gap, all of that is true for the immediate future. The one difference between now and 2009 is that the money multiplier is now working somewhat better than it did in 2009, and as a result, M2 broad money growth in the US is now over 18%. That is much faster than M2 growth ever was in the immediate aftermath of the global financial crisis. So the interesting thing is that the velocity, of course, velocity of money is down sharply, and so we're not going to get inflation anytime soon. But if we get a normalization of the economy, and you still have an enormous increase in broad money, then at some point, say 6 to 8 months down the road, when the economy is operating normally, you could get a period of volatile prices, and including some periods of inflation surprises down the road. I don't think it can be ruled out quite as much this time as it could in 2008-9. I mean, I think. Okay,
that's very interesting. Just before we move on to kind of some of the audience's questions, just wondered what your collective wisdom was on China. This is where everything kicked off, and you're now seeing a lot of figures implying that things are recovering quite sharply. Does that make you optimistic about its role, its central role in the world economy, and its recovery? Bill, have you got any thoughts?
Yeah, I mean, it depends what you mean by recovering, of course. As I mentioned earlier, we're definitely seeing a recovery in the supply side of the economy. In that sense, China is back to work to quite a high level, I would say. versus pre-crisis, but the demand side, the consumer side, and the export-driven demand is just not there. That's going to take a lot longer to recover. So even though China has had what is arguably a very good crisis in terms of the disease and has got back to work relatively quickly, it's kind of an interesting case study for the West, who may not have such a good experience with the disease, may not be able to get back so quickly, and may have an even longer period to go before they can get the demand side going again. So I think that's the issue for China, and perhaps we'll see some policies encouraging consumer demand and other things at the NCP coming up. Yeah, that's I think the situation there.
Anybody else have some views on that,
yeah.
PK?
Quickly on China, I think the immediate numbers are actually quite good. Exports have done remarkably well in April. And mainly because of demand from the rest of Asia, the likes of Japan and Southeast Asia, Taiwan. That's where the exports went, and also fixed asset investment grew month on month quite strongly, 7% year-on-year growth in fixed asset investment. So a recovery of sorts. But I think the problem for China is that China has massive overcapacity in all the old industries, steel, aluminium, cement, and therefore China needs fixed asset investment to be growing at a quite strong pace. And that is not really sustainable, and it's very unlikely that you're going to see fixed asset investment growing much more than 2 or 3% this year. So China will have to begin a serious transition away from being an investment-driven to a consumption-driven economy, and consumption isn't really doing well, as Bill just pointed out as well. So there is, I think, a pretty serious challenge facing the Chinese economy that is structural, and that will confront it in the course of the year.
Right. Michael, maybe just come back to what we were talking about at the start about why you're optimistic about the recovery. Just in terms of if there is a second wave of infections, or is your view just that wouldn't be as damaging as the initial wave, or do you just think there's not going to be a second wave, or how should we interpret your optimism there?
Well, I think let's return to the bigger picture. I think, what the coronavirus crisis has done is to accelerate trends in the world economy that are already evident. Yeah. The clearest of those is a clash between China and the US. What we've seen, particularly over the last 2 months, is a very clear statement by the US authorities that they are now drawing the battle lines. And I think if you look at the alacrity which they engaged in swap lines, and more particularly who they gave the swap lines to, and they essentially established an informal grouping of 15 countries who now have complete access to dollar funding. Now, that is a significant development, because I think what it foreshadows is the economic equivalent of NATO that was set up in the late 1940s, early 1950s to contain militarily the Soviet Union. What America is trying to do now is to contain economically China. And I think that what you will see in the next few years, maybe even in the shorter term, is initiatives from both sides to try and establish or draw those lines more clearly. America is very obviously sorting its friends from its potential enemies in terms of doing it. Dollar funding is critical to the world economy and critical to finance. The whole question about whether Asia can enact policies to lift itself out of this dip very much depends on their access to international funding. And I think that Bill's made that point as well. That's the issue we've got to look at. How is China going to respond? I think what they're doing is playing a stealth game, a very clever game. What they're doing is trying to preserve the integrity of the yuan currency. There's been a lot of focus on maintaining parity with the US dollar. If you look at monetary policy initiatives over the last few weeks, they've done what they normally do during potential currency crises, and that's kept money market liquidity tight. And they basically eased up on reserve requirements for the fringe banks, the agricultural banks, and the regional bank, try and take the liquidity pain away. So I think that what they're trying to do is to maintain the yuan, and then when that is stable, they will enact a very clear policy stimulus.
Yeah,
for next year.
That's really. I suppose the issue though is just that's fascinating perspective on what the US is trying to achieve. But you think in doing that they'll just ramp up the spat with China from the trade perspective, and would that be damaging for Asia?
I'm not so sure that they'll ramp up a spat. I think this is much more of a secular challenge between the role of the US dollar in the world economy and the role of the yuan. And I think if you look at the size of the Chinese economy and the ambitions of the Chinese administration, they clearly want the yuan to be a major international currency. At the moment, China's big gap compared with America is that the financialization of the Chinese economy is lagging significantly. They need to get a much deeper financial system enacted. And what they'll have to do is to open up their bond market. They'll have to trade credit market in yuan and develop a digital yuan to circulate within the Asian regions. Now, all those initiatives are basically beginning, and America is now pushing back. The obvious to say, well, why should we let American capital finance Chinese development?
Right, that's really we're just aware of the time. There's a question about whether we think there will be negative interest rates in the next few years. I mean, there are some kind of negative rates already, but what do we think of that? Jason, do you have any thoughts?
Yeah, obviously the market's pricing it in. If you look at longer dated Fed funds futures, that's a probability. It doesn't seem like that's what the Fed wants to do. There's issues with, money market instruments in the US. It probably doesn't have a big marginal impact for them to do it. It's, a last resort option, right? The BOJ probably didn't want to do negative interest rates. The ECB probably didn't want to. The UK probably doesn't want to, but as a tool of last resort, it's something that they could consider. So it's probably unlikely, at least as the initial policy tool, they'd probably more likely look at something like yield control targeting, like Japan did before that. But it's hard to rule it out, and the market's obviously giving it some credence.
Interesting, Bill. Do you agree with that?
Yeah, I can't add much to that. I think the balance of probability is that we may see it in the US, other large developed economies, but yeah, completely agree with what Jason said.
Okay, PK, any last thoughts?
I think if they do that, it's absolute 120% madness. I mean, if you look at the crises that we've had in the last 10 years, it's all a question of central banks not understanding how the financial system works. And going down interest rates or negative interest rates is a lunacy policy. The essence of the problem is that the world financial system is no longer a new capital raising mechanism where interest rates matter in terms of comparing the cost of capital. It's a refinancing mechanism where basically what you need to do is to roll over existing debts. If you need to roll over existing debts, you balance sheet capacity and liquidity. It's not about interest rates at all. If you have low interest rates, you're encouraging more debt take-up. I mean, this is the problem we've got ourselves into.
Yeah, PK, just last word to you. If you have any last thoughts?
Well, I completely agree that negative real interest rates, negative nominal interest rates are complete madness. There's absolutely no need for them. There are enough tools available to to adopt more aggressive forms of quantitative easing of the sort that Japan has increasingly used over the past 20 years. So negative interest rates of the sort that the ECB has resorted to have really done nothing to help. So quantitative easing is much the easier solution. And I think this time around, there is really no need to go that far. We have a temporary stoppage in the economy. Massive amounts of fiscal stimulus have come through. I don't see any reason for
I think that's a good summary.
Monetary.
Excellent. Okay, well, I think we'll leave it there. But listen, thanks to all our panelists. I think we got through a lot there, even though it was only half an hour. And I think we'll leave it there. But thanks for joining in, everyone.
Thank you.
Thank you.
Thank you.
Bye.